Hi there, and thanks for joining me. In this video, I'm going to unpack a few questions, starting with how can we overcome the fear and the anxiety of everything seemingly about to crash and set ourselves up for peace of mind and confidence as we move forward. Now, I ask the question because right now, many people are operating on top of the R word, known as recession. As a matter of fact, some believe we're already in a recession, while others say that we are definitely not. More on that in just a minute. First, I want to say welcome to my channel, the Everyday Millionaire Podcast. My name is Patrick Francini. I'm the host of the show. And in these short videos, I'll be sharing with you the lessons I've learned and knowledge I've gained over almost 40 years of experience being an entrepreneur and a real estate investor. And I'll be combining that with the many conversations I've had with my everyday millionaire guests who share their lessons learned and their wisdom gained on the journey they've gone on to achieving their financial and lifestyle goals. You can listen to those interviews right here, anywhere on this channel. Look around. And after all that, if you like what you hear, I have a special free insider newsletter that will give you the front of the line opportunities to learn even more. And that link is down in the description, along with my other social media links. Follow me on Twitter, on LinkedIn, the Everyday Millionaire Facebook page. Hope to see you there. So, are we or aren't we in a recession? It seems the definition of recession may be changing, but technically we're not. Because a technical recession is when we have 2 consecutive quarters of negative gross domestic product, or GDP growth, which is currently not the case, especially here in Canada. But more details on that topic just shortly. I'll share something with you. But before we go there, let's go back to working on answering the question, which is the problem that's being faced by many, which is when people hear we are in or we're on our way of going into a recession, it creates a lot of fear and anxiety for them. And just the possibility creates a sense of panic or at least a degree of uneasiness. And some have the very real fear of layoffs from their job. Now, we add to that the rising cost of debt because of rising interest rates and the rising cost of goods driven by inflation. And then the fear, the uneasiness is exacerbated because with that view of the world, we generally only see things that are wrong with the economy, often referred to as confirmation bias. What I just described is an overview of how many people are saying they feel these days. Or said another way, it is the current state of emotion for many people, and it's built on fear, on uneasiness, and certainly on the uncertainty. So what I'm here to share with you in this video is one thing that all everyday millionaires have had to come to grip with. And it may even be the hardest thing, and that thing is being aware and of not making emotional decisions. Emotions are being driven by the negative headlines, the naysayers, and the inexperienced armchair economists. Right now, in both Canada and the US, you can't open a newspaper or your device without being inundated by the negative headlines and social media, which is actually as bad or worse than the news outlets. It seems right now as if Twitter is an echo chamber of all the things that are wrong in this world. Okay, so right now you may be asking, Patrick, what's your point? Okay, here we go. My point is, regardless of what appears to be happening or really is unfolding in the world, we need to make decisions for how we will financially look after our family and our businesses, and as importantly, what opportunities will present themselves that you can leverage to build your financial future, your financial security, certainty, or even financial freedom. So we start to break things down. Are interest rates and inflation rising? Absolutely, yes they are. And the geopolitical issues and the unrest is real. And absolutely there are some problems. But within that, your work, your life, and perhaps your business carries on. And you need to look at certain realities, not just the headlines, to assess where you see the future going or how you see the unrest and the uncertainty unfolding. This is where we have to consider that recessions are known for creating the most opportunities for building wealth. Many everyday millionaires achieved the status of everyday millionaire by knowing what to do in times of recession, in times of uncertainty, and emotional times such as we've just gone through over the past about 3 years. So the big lesson that I want to drive home today is to learn and develop the discipline to make data-driven decisions and not emotion-driven decisions. Reactive decisions are made during the highs seen in times of FOMO, like the fear of missing out of the past 2 years of Canadian real estate, the crypto market, the equity market, or the now fears of an economic slowdown. The crashing stock market, rising interest rates, the geopolitical issues such as what is happening between Ukraine and Russia, or in China, Europe, the UK, oh my gosh. And let's not forget about the current discourse of politics that are unfolding right here in Canada. The big question is, how do we disconnect from the emotion? What data do we need to consider? Where do the opportunities lie? And quite frankly, those are all great questions. But let's start by stepping back and taking a pragmatic approach to growing wealth. Now, almost 40 years later, I feel like I've made all of the mistakes in creating and building my financial future. I've chased money and thought I could get rich quick. I've started businesses with partners I didn't align with. I bought hot stock tips that were guaranteed to 10x. I've tried MLM, multi-level marketing, and even options trading. And while there is a lot of stories of these things making millions of people millions of dollars, what I discovered is that there is no get-rich-quick strategies that you can count on, and that emotional decisions are far more wrong than they are right. What I've come to learn and research is that there are many things that everyday millionaires understand, from their specializations and their leadership qualities to their innovation and commitment to creating and even building a plan and then taking action. These are all important, and I'll be discussing those on this channel. But today I want to connect you to the source of what drives an economy so that you can look past the clickbait style of headlines and look for the data, the right data that will help you see the future. It's really not that complicated. When I started investing in real estate more than 20 years ago, I began learning and understanding the economic drivers and influencers that impacted real estate. But those same factors applied to business in general. And as much as I love to invest in real estate, I'm also a business owner. And aside from sales and marketing and HR and building a great team, managing production and inventory, all of those things, I needed to understand what makes an economy, and what are both the positive and the negative factors that impact my business and my real estate. In other words, how can I make pragmatic, data-driven decisions rather than reactive, emotional decisions? Now, here's where I will add some depth to this video. I'm going to share with you what one of my businesses, the Real Estate Investment Network, refers to as the long-term real estate success formula. But you're going to want to make a note that this success formula applies to anything that is at the effect of our economic health. But let's just start here. An interesting concept. It's called the long-term real estate success formula. Within RAIN, or the Real Estate Investment Network, one of the businesses that I own, we've been teaching this for 30 years. But this isn't really about real estate, although it could be. What this is really about is what's happening economically. How do we look at making decisions based on data, not emotion? And this is one way to do that. Now, when we look at the future, what do we want to say? Well, let's treat it like we're a surfer. If you've surfed, what do surfers want to do? Or if you've watched surfers, we want to get out in front of the wave, right? We want to get out in front of the wave and ride the wave. But number one, we have to know that in the ocean, we're in the right ocean, the right part of the ocean, that we're going to get waves. We need to know that the waves are going to be important enough or big enough to ride, and we want to ride those particular waves. So when we look at what we call the long-term real estate success formula, we have to look at that as a wave, because when we see what's happening economically, we realize that we can actually see the future. And the future is driven by one fundamental thing that we often hear about, talked about, but not everybody understand what it means, and that is gross domestic product. Now, these are the key economic drivers that not only drive real estate, they drive an economy. So what is gross domestic product? What is GDP? Well, I use the most kind of basic explanation, if you will, and I say GDP growth is expressed as a percentage, and it is a snapshot of the economic health of a country, of a region, of a city, for example. And when we have strong or we have positive GDP growth, let's say it's 2, 3, 4%. You're in China, it's 7, 8, 9, or 10%, although that's slowing down. It's something to pay attention to. But when we look at positive GDP growth, it means that the economy is churning. And when we have activity within an economy, whether that be infrastructure projects or businesses that are building things, it could be a hospital, by the way, could be infrastructure, partially government, federal, municipal, provincial, and private, could be any of those things. But the point is that people are working because there's a lot happening. Could be in the manufacturing, retail is strong, restaurants are strong, car sales might be very, very strong. So the point is this: when we see a positive GDP number, we can say, okay, people are working. When people are working, they have money. When there are jobs to be had, what we start to see is employment growth. And why do we see employment growth? Well, we see employment growth because people move to where the jobs are. When we look at immigration coming into a country, the immigrants got to know that there's job potential here. And when we see people that are going, in the case of Canada, interprovincial migration, what do we see? They're moving from one province to another. Well, there's a number of things that will cause that or drive that. But one of them, of course, is that I can get a job. I can get a well-paying job. And then on top of it, in what's happening in Canada regionally right now, we start to see that there are some provinces that are housing is less expensive. The cost of living overall is less expensive. There is no provincial sales tax, and job income is relatively higher than in other areas. Well, what does that do? That attracts people. That's why we're seeing a lot of people, for example, moving out of Ontario, immigrants coming into Ontario and then going to Alberta or Saskatchewan, for example. Now, that's because of cost of living, cost of housing, good jobs, good wages. So people go there. But when you have employment growth, you then have population growth. When you have population growth, in the case of housing, you see an increase in rental demand. Why? Well, because when people move into a country, when they move into a province, what do they generally have to do? Is they rent. And they rent for a number of reasons, by the way, not the least of which is because they don't know, number one, that they got the job or how long it's going to be. They don't know exactly where they want to live. If you're coming from another country into Canada, for example, you want to kind of find out where culturally you can find your people, that speak the same language and practice the same traditions. And you want to be in that and immerse yourself in that like-minded community, if you will. Then on top of it, you don't likely have a credit rating. So what do? You rent. So you move into that area, you rent, which means increased rental demand. Then ultimately we see decreased vacancies, and then we see increased rents. It becomes that old supply and demand issue, which never goes away. Doesn't matter what industry it is. This happens to be housing. After a period of time in the world of housing, we see prices go up because people are renting, and then they've got their job, they got their credit rating, they're moved in, they know where they want to live, they're satisfied with this particular city, and they go, okay, I'm going to buy here, I know where I want to live, and they start to buy houses. And then ultimately supply and demand, again, drives real estate prices up. Now, this isn't a conversation about real estate, but when we step back from it, understand that the data, GDP growth, as an example, employment growth, another part of that equation, immigration or interprovincial migration, another part of that. That all speaks to a healthy economy. As I say, that's where restaurants start to get full or stay full. We start retail spending. We see people renovating their homes. They're buying vehicles, they're buying boats, they're recreating, they're traveling because they're confident in what's happening. What's happening right now is there's a lot of fear mongering, a lot of talk about a possible recession, geopolitical things, as I've said earlier. Now, when we look at that, we start to see the other side of that, which is the influencers that come into play. So right now we're at the effect of what? Rising interest rates. We just came off the pandemic. We're post-pandemic, and then we've got politics. Boy, oh boy, can we ever get fired up about politics, can't we? Now, this isn't data. These are things that drive emotions. They do affect data, but these are emotional conversation, emotional issues. And interest rates, for example, drive a lot of emotion, a lot of confusion, a lot of uncertainty. They have an impact on the market, whether it be the real estate market or the business market, because small business owners or business owners overall are reluctant to borrow capital to reinvest in the business. That can slow things down. So these influencers are not necessarily short-term, they're shorter term. Interest rates won't stay high forever. Politics will change. Politicians come, then they go. And so we realize that these influencers, when we're stepping back and out of the emotion, we can actually say, this too shall pass. So yes, interest rates are a big deal right now. It's the only conversation going on in the real estate world, that and supply and why aren't listings, and oh my gosh, there's so much happening. But when you break it down, you can get out of these emotional decisions. Now, here's the thing about an economy as well. When we see negative gross domestic product or no GDP growth, what we start to see is growing unemployment. Well, why is that? Well, because if there's no GDP growth, it means that we're not being productive. We're not actually producing goods. We're not building things, and people therefore won't be working. Employers don't need them because things have slowed down that dramatically. We start to see unemployment go up. We start to see a population decline often in a region. Well, why is that? Well, because people move out of there. If there's no jobs, they got to go find a job. They'll move elsewhere. They'll go to another city, another province. Heck, they might even go to another country if they can find a job, because people need to make money. They need to work. And whatever social program, unemployment programs are in place are not necessarily long-term or sustainable for some people. They have to make more money. So the point is this, is that in the world of real estate, what we see is that population decline. We see rents, or the demand for rents, coming down. Then landlords actually say, okay, I'll lower my rent. The supply demand, because all of a sudden there's more supply than there is demand. And then people who are afraid of losing their job or have actually lost their job, maybe some of the household income, the significant other has lost a job and there's only now one income into that house. What do? They go, I got to sell my house. I got to get from underneath this debt. So then they move out. Well, what that causes, of course, is that more listings come onto the market, supply goes up, demand is still soft or goes down, and prices come off. Now, this all to say this, we're not there yet. We're having a lot of conversations about recession, potential recession, where it's going. Everybody seems to know. And I have to be honest with you, nobody really knows. I look at the data and I go, this could be the great non-recession. Are we going to slow down? Yeah, I think we are. Do I think we're going to go into big negative GDP territory? I'm not seeing signs of it right now. Why not? Well, because people are working. Unemployment right now is about 5.1 to 5.3%. That's record lows. It's so healthy. As a matter of fact, it's a little bit too healthy. It's hard to find good help. You hear those stories all the time. There's not enough people when your unemployment is that low. What you will start to see is, if we are going to see some slowdown, we're going to see unemployment start to come up. But I have to say this, 5.1 is actually not a healthy unemployment rate. Although it's record lows, it's not all that healthy, because you can't find good help, which limits projects. Secondly, you're going to start to see wages start to rise. That's a potential for that starting to happen. When we get into that 6.5% unemployment, that's a very strong economy. It means there's churn through the market. People come, people go. There isn't huge wage demand. There is a availability of labor, and that's really healthy. But we're 5.1, 5.3. Got a lot of spread between 5.3, let's say, and 6 or 6.5. Although the headlines will make it a much bigger deal. It's only to say this: look at the data, not the emotion. So when we start to understand these things, we can make better decisions, whether it be real estate or just in business overall. When you look at the equity market, when you look at what's happening on geopolitical, lots of emotion. Get out of the emotion and into the data so you can make decisions. The influencers that we talk about and that I just mentioned to you, remember the thing about influencers is that they're short term. It doesn't mean they're really short term, they're shorter term. Could they be a couple of years? Yes, they could. Do we think interest rates are going to come down in the next year? I doubt it. Maybe. I don't see them going up tremendously. I think we'll see a rate increase in early 2023, and then I think the Bank of Canada will kind of back off. We'll see what happens there. But the point is this: is the economy is in fact starting to slow down, which arguably people wanted it to do to kind of slow down inflation. I happen to be in the camp that The inflation that's going to slow down really isn't going to have a strong impact in a positive way because food prices aren't going to come down. I don't see fuel prices coming down. And I think that the cost of living overall and house prices, although they'll come down in some areas, it's offset by the increase in interest rates. All I'm saying is this, is that I don't think inflation is going to come down as much as the Bank of Canada and the politicians seem to suggest it will. That's just my view of it. But having said that, things will slow down. The economy will slow down. And again, it doesn't matter whether you think that's a good thing or a bad thing at this point. When we look at how do we invest capital, how do we move forward, how do we make decisions, the point is this: stay connected to the data, stay out of the emotions, and you'll make far better decisions. It's the one lesson that everyday millionaires will always share: to step back and get out of the emotion, make data-driven decisions. Okay, let me share with you. Okay, as we expand on what I just shared here, there are a couple of things that I want to mention regarding these economic issues. Is that while many people are very afraid of slowdowns in the economy and slowdowns in the markets, such as real estate, I'd invite you to consider that economies, real estate, the stock market go through cycles. Emotionally, people are excited and fired up about the peak of a market. Everybody's making money. And for example, we have to consider, just like I say, the real estate in mid-2020 and what it led to the middle of 2022. Many were feeling like real estate investor geniuses. And now as interest rates rise and the real estate market slows down in some regions, many face the reality that they're actually being real estate speculators and not investors. And the same story holds true for the crypto and the equity market. Point is this: investing decisions made based on emotion, not data. And that is the hype that everybody is buying into of getting rich quick, at least on paper. FOMO and emotion-driven decisions. It's an interesting time, isn't it? There is a lot of things going on, lots of confusion and uncertainty. I get it. However, for everyday millionaires, recessions and market crashes are their opportunity to build and grow their wealth. For the savvy or the sophisticated investors, it's almost like a Black Friday for investors. So the first point that I want to make is that people who take the time to listen differently, to learn and seek different points of view, can actually use slowdowns as their opportunity to build immense wealth and taking advantage of the opportunities that were not there the past few years. And there are more everyday millionaires achieve that status by taking advantage of opportunities through a recession than any other time. Currently, we are not in a technical recession. Unemployment remains at record lows, and although GDP growth is slowing, we're not in negative territory, not close yet. And before you say, yeah, but that's where we're heading, I would just suggest that while that is possible and may seem probable, we have to consider point number 2, which is our unemployment rate remains at historical lows. 5.1 to 5.3% is very low. And until we see unemployment rates rise to 6 or even 6.5%, most people are making an income, and that's what keeps an economy going. Will it slow down? Likely. Whether you're looking at business, at real estate, at cryptocurrencies, or even precious metals such as gold and silver, think in terms of years, not months. Don't speculate. Look at the data. Consider the possibilities and the probabilities, and then create a plan, and then execute on your plan. Adjust as necessary, but look at the data. It used to be a diversified portfolio was 30 stocks spread out over several sectors, and now it means owning some stocks, owning some real estate, a percentage of gold and silver as insurance, and even a small amount of Bitcoin perhaps. The point is, diversification means something different. The world is shrinking, given the advancement of technology, and it is also economically changing at a very rapid pace. Education is really the key to staying away from the decisions driven by emotions and getting grounded in decisions instead driven by data and a strategic plan that you commit to following. What everyday millionaires know is that sitting on the sidelines is just not an option. Learning, research, searching, and creating opportunities is what opens the door to lifestyles that are built by design. Okay, that's it for now. So thanks for listening. If you'd like to hear more or learn more, remember you can go in the description and follow the link to sign up for my free newsletter, which is an opportunity to get front of the line opportunities to learn even more about investing. And as you know, the algorithms on YouTube do matter. So if you got something out of the video today, I'd only ask that you hit that thumbs up button and subscribe. Or if you don't like it so much, go ahead, give me the thumbs down. But if you do, just drop a comment as to why you didn't like it so I can work on improving. And if you did like it, then that's great too. But give me a comment about what you liked. Either way, thanks for joining me to support you on your journey to being an everyday millionaire. Thanks for listening.